Welcome back, fellow investors. Since the rise in interest rates are affecting the overall consumer purchasing power and simultaneously the market has risen quite a bit over the past months, I decided to take a look at some ninja stocks, no income, no assets stocks, to hedge my heavily commodity-based portfolio against the potential downturn. So for a number of reasons, I decided to take a look at RobinHood Markets. In this video, we're going to take a look at Robinhood's financial statements. We're going to pay especially close attention to its balance sheet section, assets, liabilities, and equity. We're going to look at the number of shares being printed. We are going to also look at the cash flow statement and the cash flow generated or being lost by the company. Then I'm going to make some conclusions. I'm going to attempt to put a value to the company, and I am going to also review its technical chart and make some conclusions as to whether it is a good buying or shorting opportunity. So let's start our review. So first, let's look at the balance sheet section. In the balance sheet, we can see that the company had quite a bit of current assets, $24 billion. That is fine. Barely any non-current assets, or about 500 million. And these non-current assets are goodwill, some intangible assets, restricted cash. Okay, restricted cash is good, but it is probably offsetting some other liabilities. Operating lease rates of use, which I don't know, like again, you are probably not buying very often these type of assets. They're extremely hard to sell or realize. So I'd say this is near negligible section. So yes, we only have the current assets. Then we have current liabilities of around $18 billion. So current assets 24, current liabilities 18. Okay, the company can survive if something happens. The good thing is the company doesn't have any long-term debt yet. So let's go forward. But the equation doesn't look very good to me. Negligible long-term assets. And the current assets just a little bit over the current liabilities. The only plus side on the balance sheet that I see is the fact that there are no long-term debt. So let's move forward. The equity section. So we had $7 billion of shareholders' equity in 2021, at September 30th, 2021, and almost, roughly 400 million, $350 million less this year. So the shareholders' equity actually went down. Also from the balance sheet, we can see that the only source of the shareholders' equity was the sale of the shares. So whatever the shareholders chose to contribute to the company. So if the shareholders, and then these shareholder equity is actually being destroyed by the losses generated by the company's operations. So in reality, the only way this company has so far managed to exist is by attracting shareholders, attracting new shareholders, new investors who chose to buy their extra shares. We'll look into it in a little bit more details a little bit further. So the income statement. So revenue for the 9 months period declined almost 2 times. So instead of $1.1 billion of revenue, we have $628 million of revenue from the transaction-based revenue. So sorry, revenue went down roughly almost $500 million, from $1.4 billion to $970 billion. Expenses, the company has managed to decrease its expenses actually drastically. If you look at, it is more apparent even on the quarterly statements. It had $1.7 billion of expenses in 2000 for the quarter ended September 30th, 2021, and had only just slightly over $500 million of expenses in 2022, so almost 3 times less. The problem is that yes, expenses went down, but the problem is that the company is not generating any income. That's problem number one. Problem number two, that it's heavily dependent on the share of sales. So to subsidize these huge expenses and the resulting losses, the company needs to come up with cash, and to come up with this cash, it needs to sell shares because it is not generating any income and has never generated any income. So it needs new shareholders, it needs new investors to continue to operate. So in the last quarter of 2022, and quarter ended September 30th, the company actually managed to decrease its losses to only $174 million, or 175, or 20 cents per share. So, which is good. A year before that, the losses were quite substantial. For the 9 months, it was almost $9 a share, and $2 a share for the quarter. So at present, for the 9 months period, we've lost $1, and for the past quarter, we lost only 20 cents, which is still a quite negative result, but things are looking better. So anyway, let's move forward. The other thing that I'm concerned with is the share increase. If you look at the share increase, the amount of shares grew quite substantially. Over the past 12 months, the company has increased the number of shares by almost 28%. So in effect, the company is diluting your shareholder value. So, and it is diluting your shareholder value, and it is simultaneously destroying your, depending on the price at which they sell the shares, they could start destroy your equity as well. So let's move to the cash flow statement. On the cash flow statement, what do we see? Cash flow from operations for the 9 months periods. The company managed to generate 610 million of losses, of operational cash losses in 2021, and so free cash flow. I did some rough calculations of the free cash flow for the 9 months period. So for the 9 months period of 2021, the company lost $671 million of capital. For 2022, the company has actually lost $1 billion of operational capital. It is hard to forecast if this is going to continue, but things look quite bleak. So we're losing a capital, the actual capital, our cash, our current assets, at a rate of $1 billion in just 9 months. This looks like a complete disaster. In the spreadsheet, I summarized some of the company's most important points. So point number 1, the increase in the amount of shares, almost 28%. The total equity in 2021, the decrease due to the company generating losses, almost $350 million. Equity per share decreased at a faster rate than the share dilution due to the company generating losses, even though the losses were generated were relatively modest. The equity per share went down at a rate of 31% due to company issuing more, almost 28% of new shares. Free cash flow generated per share, $1.05 in for the 9 months period in 2021, $1.25 in 2022. So the equity per share destruction is going on quite fast. If you, for example, look at GameStop, due to free cash flow losses, the company may survive for the next 4 quarters. Over here, I'd say the company can survive probably for maybe, well, maybe has, if nothing changes, has maybe enough resources to last for maybe 5 years. So in a way, you could say that Robinhood is a relatively stable business. Well, that is if nothing more serious happens sometime really soon. So current market price $9.39 versus the current equity per share 70.88. So equity to market price premium is about $1.50. However, I would keep in mind here that some of the non-current assets that are included into equity are quite doubtful. I would say that there is probably around $7 of equity here instead of $7.88. So anyway, there is the company is trading at 19% premium to its equity. Again, I'm going to assume that the company is going to generate $1 of losses per share in 2023, which is going to keep the leave about $7 of equity in shareholders' coffers per share. I'm also going to assume that the rising interest rate effect is going to bring down the valuations, and that the market eventually is going to value the company at roughly the value of its equity. I would assume I wouldn't actually buy this company at its equity value, because the revenue is actually declining at this point, so there is no sense to pay any premium. But if the market values it even at its equity values, then I would the cost of the company the market price of per share should be around $6.88, and that is assuming that the company doesn't issue any new shares. If the company continues to generate additional cash flow via issuing more shares, which it did previously, then this number is obviously going to be much lower. So there is a potential 27% return potential from the fundamental perspective. The other point is I don't like such businesses that operate on very thin profit margins. Any unpredictable event can really knock you out and create a lot of losses, and it'll take you quite a while to recuperate these losses through generating income on very thin margins. In this case, we're not even generating any income while producing thin margins. We're generating less of losses while operating on thin margins, and we have less of cash to advertise the company to generate income. So things look quite bleak, to say the least. Simultaneously, 27% return potential, to me it sounds like not a very good return. So Robinhood does look like a good, relatively good shorting opportunity, but it doesn't look too enticing for me. On the technical side of things, this is a daily chart. We broke down through a trading channel, and now we are tumbling down below this resistance level. There is a support around $6.70 or $6.80. This is coincides with the approximately the amount of equity the company is going to have at the end of 2023 per share. So if you go back to my Excel spreadsheet calculations, that's going to be roughly this amount of equity that you're going to have for each single share in about 12 months. That is if the losses continue, but the company doesn't issue any more shares, which is somewhat unlikely. So I would expect the price to continue deteriorating just due to the company generating losses and potentially issuing more shares and diluting the present shareholders' value. So I am not going to look at any other indicators because it's oversold, but there is really nothing positive going on for this company except the fact that the company somewhat managed to deal with its expenses, which is obviously is affecting its growth and potential. So things look quite negative, and they are probably going to look quite negative for at least next 12 months. Be careful. Cheers. Goodbye.